Hello and welcome, everybody. Happy Thursday. This is a live event. I am joined with my friend Jason Pers, our head of macro here at All Star Charts. How are you doing, Jason?
Good, man. Excited to talk through some charts with you, Steve. There's some interesting developments lately. I know that the market's been a little rough for everybody. So we just kind of wanted to come together and show you guys what we're seeing, what we're looking at, and how to navigate these style of markets because it's been a rough time.
You know, so really dicey out here these days. And we figured Jason is involved in every market. If it's liquid, Jason's probably trading it. I try to lean away from messy markets and anything that's trending, right? So we're trying to do different things and move to the stuff that's working and leave the stuff that's not working behind. This is a basic premise of just being a good trend follower, right? So there's nobody better for me to talk to today about kind of how to navigate our way through this messy market, particularly for US equities, than Jason, because what are we doing in these environments? We're looking for uncorrelated trades. And that's what today's about. Is that right?
Yes, absolutely. So trying to find uncorrelated trades, things that when the S&P 500 isn't doing too well, these things might be doing well.
45
And
liter
there's a
Lexus.
lot of those. So let's get through them. We got a ton of great slides for you guys today.
So
Excited to hit it off.
we actually, it's funny, right? Because we threw together a slide deck and we're rushing here because it's a fast market. We want to come on and talk to you guys about what's going on, how we're navigating our way through it. We got 46 charts in here. We're not going to hit them all. Right? We're going to try to hit the big points and move along through it, talk about what we're doing. But I'm going to start at the top. There's nothing better, you know, to frame this conversation, this discussion that we're having right now, than our bear market checklist. What do we do internally? We have all different lists, right? Basically, to help us figure out what kind of environment we're in. One list that we're constantly making is a bear market checklist. The bear market checklist has 16 levels that we believe are crucial and need to hold if the current bull market, and this is for US equities, this is US equities focused, if the current bull market for US stocks is to remain in place. And what's happening? Every passing day, Jason, there's more and more red on this list, right? And it's not a good thing. So where are we right now? The average stock in the S&P 500 is in 21% drawdown. We haven't seen this kind of an intense or this steep of a correction since the Q4 2023 sell-off, which was a lot longer in terms of its time frame. The Nasdaq 100 actually is already worse than that level. Speaking of the Nasdaq 100, we've been above a 200-day moving average for almost 500 days. This would be very, very normal in terms of duration for it to end right here. If you look back past bull markets, look at these streaks 450, 570, 450. We're at 497 today, right? And the streak just ended. We're now officially below the 200-day moving average. This is the most traditional, I guess, measure of the long-term trend. Would you agree, the 200-day?
Oh yeah, you go back to the old Paul Tudor Jones saying, he was always talking about the 200-day moving average. And the old saying from older traders is nothing good really happens under the 200-day moving average. Kind of like when your mom told you nothing really good happens after midnight. So you kind of want to be off out of the market most of the time if you're under that 200-day moving average.
That's great. So we're in a place where they tell us nothing good happens. That's perfect. Right. Market internals absolutely cracking again. Hasn't been this bad since Q4 2023. When it comes to risk appetite indicators or even the bond market, there's some unease here, right? Maybe credit spreads aren't blowing out. It's nothing like what we saw in just August of last year, to be clear. However, you could look at this. This is high yield bonds versus US Treasuries as a failed breakout above the prior cycle highs. This is the kind of stuff that we're seeing left and right.
No, I like the bear market checklist because all of these things are significant, and for a bunch of different reasons. One is, hey, Europe's doing pretty well. That's weird. So is it telling us that this is either Europe's going to follow this, or is this more of a short-term thing that the market in the United States is going to kind of bottom out at some point? So these type of checklists are so significant for so many reasons, but right now it's just telling you be out. And that's simple. Keep it simple. Be out of the United States at the moment. There are some other areas we might look at later, but United States being very tech heavy, it's getting into some trouble right now.
So in case I didn't scare people enough, one more bearish chart, and then we'll jump into what we're doing with some uncorrelated trades. We're so overdue for a bounce, right? It's a foregone conclusion that there will be a rebound rally coming. It could and should, in my opinion, be a fierce one. However, if and when that rebound rally comes, we have to judge it. I think we got to judge it real hard. One area that I'm looking at as a line in the sand that I want to get back to and even through any good, even if it's a mean reversion bounce at this point, any good bounce here should get us back above and overshoot these big VWAP levels from August. In terms of the mid caps, right, they're a lot weaker. I'm anchoring those VWAPs from the Q4 2023 lows. Mind you, Q4 2023 is the same time I kept referencing just a minute ago when I'm talking about these market internals charts, right? We haven't been there since then. So I think these are big levels. I want to see a rebound rally that gets us back to and through those levels, and then we'll reassess. But in the meantime, other things are working. That is why Jason is here to tell you all about them. Look, we got a big slide deck here. Tell me where to go, baby.
All right, let's hop into it. So yeah, we're all over the place here, but it's part of the reason is we're just trying to get this out to you guys because this is important information. I know everybody's trying to take a look at it. Let's go to that scan is number 10. Let's hit 10.
Look at this. A lot of things are working, actually.
A lot of things are working. So this is significant because most of the time, historically, when you see the international stocks outperforming, the United States isn't usually doing that bad. It's just underperforming. This time, the United States is actually heading down. And if you look at those charts on the right, the 90-day charts, you're seeing that the United States, while it's going down, and then some of these countries start going down a little bit with it. They started to just bounce very quickly, and now they're headed all right back up. Look at the sea of green. So these are where you look at price trend. This is the 21-day, the 50-day, and the 200-day moving average. You're seeing a sea of green in all of these. And so there are places to be, and I know a lot of people in the United States are like, oh, how do you invest in China? How do you do this? For either philosophical reasons or reasons you just really don't know how. And I think a lot of people actually lean on the other side where they don't know how. And really in the United States, it's as easy as look at all the ETFs on the left side. This is KWeb. Look at some of the companies everybody loves, Baba, Tencent. Like these are all companies anybody in the United States can buy. But all these ETFs that are listed, they're plenty liquid enough for anybody to trade. Yes, if you're running $1 billion fund, maybe you might get a little bit stuck in one or two of them. But if you're a normal trader or running a fund that's even under 100 million, you can trade all of these. They're plenty liquid enough, and especially China, Europe, Spain. Yeah. These things are very, very liquid, so anybody can trade most of this.
No, that's a great point because we don't have the tickers listed on this table. However, this is simply
no, they are. They're on the left side. They're very tiny, so people will have trouble seeing them. But we'll run you through them.
My eyes can't. I just can't. But what this is our universe of investable international ETFs, right? And all we're doing is filtering it by strength. Most of the international ETFs on this list, actually all of them have posted double-digit returns over the trailing 3 months. And when you contrast that with something in the United States, something like the United States equities market, this is what's happened this year, right? S&P is not just not giving you the returns that international markets are. S&P is down 6% this year. And then we have stuff like China up 20%, the Euro Stocks 50 up 15%, Latin America up 10%, right? So we have to go elsewhere right now to generate alpha.
Yeah, it's a good time to get out of the United States. And that's kind of the big thing what we wanted to talk to you guys about today is getting out of the United States, finding some of these other areas, not to mention things like copper, not to mention China. Like there's a lot of different areas we could be buying right now that look really, really good.
We have been so used to looking at this table, running this scan 10, 15 years now. Actually, longer than I've been doing this. Been doing this for 6 or 7 years, right? As long as I've run this scan, I'm used to seeing the S&P 500 up here towards the top. It's been literally 10 to 15 years of steady, consistent U.S. outperformance over the rest of the world. When these relative trends turn, they're driven by the big money. They're driven by institutions. And there's a big chase dynamic, right? You don't go through like 6 months of international outperformance and then back to the US. No, these trends go for 10, 15, 20 years at a time. So if we are finally at a turning point in the international versus US trend. And I think we are, Jason. We got to be prepared, and we're not late. Over any, you know, over any material time frame, you're not late in a situation like this. I'll tell you why. We just had a massive momentum thrust, and pretty much across the board. I'm using the two big indexes here that most market participants use to represent world versus US. So that's the MSCI EFA versus the S&P 500. They just had their best week ever. International stocks relative to US equities. So I think all dips at this point are to be bought in terms of moving your portfolio to more international and less US.
I like the way we said this in the analyst meeting yesterday. Well, sorry, not we. You said this, which is when we see these dips going forward, they're usually going to be opportunities now. Now that we've seen the relative strength flow into this area, and we think we will probably see a dip in the international stocks at some point soon, and that's probably another opportunity to get involved in the trade if you don't like buying it up here. So be patient on it, but at the same time, it is showing massive outperformance.
There's a great question in the chart. These markets have underperformed forever, so they aren't even really catching up at this point. Here's the thing. When we talk about US markets, the patterns look like this, tops, right? When we look at international markets, right, I'm talking about the absolute trends here. Forget the relative trend, but they are making progress. Here's what's going on with international indexes. This is the London FTSE 350 and the German DAX. New all-time highs. They just keep cruising higher. They look so good on an absolute basis, right? They could pull back, retest some key levels here, and I think those dips could be bought. Look at the base in Italy.
That's a beautiful base. I love look, that pattern.
I mean, we could just go one by one, right? This is the European financials. Could you find a more risk-on group overseas? Hard to. If I showed you the EWG, right, Germany, you could zoom out to the dot or the financial crisis highs. We're getting a base breakout there. France looks the same way. When you look at something like China, right, suffered a far steeper drawdown the last cycle, but still a big base, a big reversal pattern. International equities have arrived. It's time to add them to your portfolio. However, I think we got to talk about commodities right now too, because it's not international stocks. Am I wrong? You could be making a lot of money in the commodities markets these days as well.
Yes, because I think a lot the thing that we keep getting into is everybody's like, oh, I don't want to buy international, and they have their reasons, whether it's underperformed for a long time. Look, you got to think about it in your time frame. If you're a trader, you're trading over a 3 to 6 month period of time. What do you care if international stocks are in a bull market for the next 10 years or if it's just this year? So right now we're seeing that move this year start to happen, and we want to be long it. And we're seeing other things in the commodity space saying, hey, this could be real. So let's hop into some of those now.
We got to start with gold, no?
Yeah, let's start with gold. Got to do it.
Look at how good this chart is, man.
Ooh, so gold's just been in this massive uptrend lately, and everybody's been going, it can't continue for this reason, that reason, or another reason. And when you look at gold, like relative to the S&P 500, it's killing it. It looks great. Once again, it's an uptrend. So, you could buy dips if you're that type of buyer. We bought the breakout a long time ago. So once again, it's a hang on to these trends. But I think the next thing that we're really going to see is that catch-up trade happen, which is silver. Okay. Silver has been the massive underperformer for a long time. Everybody asks me, when's silver going to catch up? Look, over the last year, silver is actually pretty much flat with gold. It has performed just about the same as gold. Year to date, actually, I haven't looked recently, but today it was actually up more than gold just this year for once. It hasn't done that in a while. When silver outperforms, it is the most massive catch-up trade you will ever see in your life. All of a sudden, silver starts to outperform, and everybody tells you that, hey, it's a new monetary system. Hey, central banks aren't buying silver, blah, 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 whatever it is. Next thing you know, miners start to catch up. Silver goes crazy. And this thing can hit 50 very quickly. So if we get a new closing high this week over, I'd say 35, let's say we close around 33, 33.50 to 35, I'd say this thing's probably headed to 50 pretty easily.
Yeah. Despite the strength in gold, the risk on ratios for this theme are trading at the lower bounds. So if you look at gold miners relative to gold, they're trading right off of multi-year lows. The same with silver gold. However, with the way gold looks right now, this chart and this breakout, I think you have to make the bet on the juice here and go with silver catching up. And I don't think there would be a better place considering where those ratios are.
Bet on the juice. But no, you're right. I like the way you put it because everybody loves the catch up trades, but really it's all about relative strength. So when we see that flow in there, man, it's going to take off. And I love this chart, Steve. This is one of my favorites. Just looking at gold versus stocks, we're seeing that hit new highs finally after a while.
Yep.
And this also tells you a little bit about the environment. Everybody goes, man, whenever I post this chart, they go, you're so bullish on gold. It's like, well, I'm just telling you, it's going to outperform the S&P 500. That's all this chart is saying.
Well,
And
Jason,
usually when that happens, go ahead.
no, but you could tell them it has been. It's
It
been a
has
year.
been. Yes. Well, people don't want to hear that, Steve. People don't either. They love gold or they hate gold. And I know that, but once again, it's a understand like as a macro trader, like Steve said at the beginning, I will trade whatever is in front of me. If gold is in an uptrend, I'm going to trade it. If gold's outperforming the S&P 500, I'm going to trade it. But more importantly, the intermarket analysis is telling us when this happens, the S&P 500 is usually not the best place to be for a little while. So once again, looking at gold, looking at some of these international stocks, looking at copper, some of the other commodities, you can find places to be, and not to mention gold miners. That's GDXs in the U.S., GDXJs in the U.S. So there's a lot of U.S. industries that are actually doing decently, but you have to look a little bit outside of the heavily tech-weighted S&P 500 at the moment.
Dude, Dan Marchese, one of my favorites, said silver chart even on a weekly G's, it's a LFG setup.
Yep.
I don't think I could have said it better.
Yes.
I mean, just look at it. Here's what I think. When I look at this chart of silver, I said, man, that's going to look a lot more like that chart of gold soon.
Ooh, dude, I agree. And when you go back, I post these charts all the time on Twitter. You go back to the 70s, you see this massive catch-up trade that happens in silver. You go back to the 2000s, you see this massive catch-up trade that happens in silver. It happens over and over again. And at the same time, the same kind of information comes out. Central banks aren't buying silver. People don't like silver. Silver's dead. There's no industrial uses. Blah blah blah.
Right.
When a sector becomes risk on, you're going to see it move into other areas. And gold miners, silver. That's where you're going to see the next big move in precious metals. As long as this trend keeps holding.
I got a tougher one for you. I think this was easy. I think silver here, it's almost like one of those trades I look at, I'm like, this is too easy, right? The catch up, the amount of catch-up juice here in silver is crazy. Gold has already hit two targets coming out of this base. Silver's literally just resting on the upper bounds of it. The breakout literally hasn't even materialized yet. Now, industrial or precious, okay? Because copper looks damn good too. And I could make an argument that copper is also like silver, right? It's a multi-year base. Hey, check out silver, multi-year base, just coming out of it, barely, right? Silver's more on its way. Copper's right there at the upper bounds, though. Is this not also a catch-up trade with gold? Like, would you look at copper and say the same thing that I just said about silver? That should look a lot more like gold in the future too, or no?
So it's a yes and no. So this is how the commodity cycle works usually. Usually you see gold break out 10 to 14 months later, you start to see silver make a big copper start to make a big move. So yeah. I think at some point you're right. Like I think this is going to really take off. We are already long copper. I do like it as in the general theme of things. If we're talking macro trading is all thematic. So meaning we're looking at copper, we're looking at China. These things kind of work together. We're looking at gold. Why is everybody running at gold? Who's buying it all? Start to look at a China again. You kind of put all of this together as one big macro trade. But I also think that copper is ready to really do the next phase of that catch-up trade. Right now, I really like the idea of having smaller positions in all three of these things. Yes, you could have one big position in one, and you could say which one will be the best. I don't know right now. Gold has been the massive outperformer for a long time. That probably won't continue forever, but I don't know how long it lasts. It could last another year. Who knows? So having small positions in three different, meaning gold, silver, and copper, which the copper ETF is CPER. Small positions make sense here.
I couldn't agree more. I want to buy the fresh breakouts, right? And I want to get as far away as I can from the fresh tops.
No, I agree.
Aluminum's really interesting here. Jason, I can't help but pay so much attention to the news cycle these days because it's so goddamn noisy. And if you know how to read it, the signals that keep popping up there have been wild. Like if you just think about it, we can't rally risk assets on the best news, whether it's Bitcoin, the stock market, any of this stuff, right? However, we also have a completely separate situation with all the tariffs. Every day, we're raining down like bad tariff news on one industry group after another. The base metals have been at the forefront of it. They always are. They just enacted the tariffs. Is it one of those like short the rumors, cover on the news situation? Like I'm looking at Cleveland Cliffs, I'm looking at copper stocks, I'm looking at all these things. I see this base in aluminum futures. These stocks have been killed. Materials worse than anything since the election. There's got to at least be like a big bounce coming in that space, no?
Oh, I agree. I think there's a bid, especially, we got long aluminum. It really hasn't gone anywhere. It's literally been the most sideways trade since our first buy signal. But once
Yep.
again, like that's how these things go. It gets up to these upper bounds. It might move sideways for a little bit and then break
Yeah.
out. But then once it breaks out, you're talking about all the names you just listed, all the sectors you just listed will
Yeah.
certainly follow it. And copper leading the way, like that's the signal you need. If you see copper leading the way, aluminum's going to follow. Very similar to like the gold silver ratio that we continue to talk about. So copper's moving, aluminum will probably move, steel will move, HRC steel will move. A lot of these things will probably follow it. So I agree. And Cleveland Cliffs is also a very good brand as well.
The conversation we're having, we're talking about gold, we're talking about silver, we're talking about gold stocks, silver miners, we're talking about copper, we're talking about copper miners, Cleveland Cliffs, Tech Resources, right? It's all a group. It's all a big theme. It's just like a year, 2 years ago, it was like, oh, look at Nvidia popping off, right? Just had their best earnings report ever, May 2023. How about Broadcom? How about Apple? How about Microsoft? It's all the same group, right? One's really working and then another one starts working. You're almost like making a list, right? All of these in this group are working, short list of the ones that aren't. Let's just keep buying the ones that aren't working and bet on them catching up to the others. That's what's going on with commodities in these uncorrelated trades right now. Whether it's copper, gold, material stocks, we're going to talk about energy in a minute, right? You can start to make the bet. They all move together. Here's copper and gold. So you would say, oh, this is a really offensive commodity and a really defensive commodity. No, they're both commodities, right? And they follow one another. So as we are successful, right, in our trades and our positions in some commodities, I think then we want to favor other commodities more, right? And just broaden our scope, right? And take that as information. This commodity is working. Well, maybe this commodity will probably work in the future too.
Yeah, and we've created systems at All Star between me and Sam, and something that I've worked on for years, which is the idea of how the commodity cycle runs. And usually we see gold run, and the next thing you know, we'll see silver, copper, and then like the last one to really come up at the end is always oil. Think of 2020, great example of this. Copper, gold, all these things moved all the way basically to August 2020. And then oil was dead in the water. Oil didn't go anywhere. Even the energy sector, yeah, it popped up a bit, but it came right back down.
Yep.
November 2020 is when that thing took off. So then it takes off and it basically never looked back for, 2 straight years. So, be patient with some of these, but just be open-minded to, hey, this could be the next mover. So I'm going to be putting on, ready to put on position, put on a buy stop, put on an alert, however you trade, and be ready for those to start moving.
Yep. Oil's at the lower bounds. I don't have a chart here, or else I would throw it up. Oil's at the lower bounds. I'm looking at all the strength in other commodities markets. I'm saying, boy, it's got to dig in here. We'll see. However, one thing I know that's not just bullish for commodities, but is actually bullish for anything that's denominated in this currency is a falling US dollar, right? So whether we're talking about commodities or international equity markets, a falling US dollar should really only be a tailwind. And that's what we have. We're breaking back into the box. Jason's chart here shows this 1 week rate of change blowing out in a way that we really haven't seen it since, boy, the last major peak and rollover, which was late 21, early 22. No, it was late. It was fall of 21, right? And then, dude, all the way
22.
back.
That was 22. You're right.
And then all the way back to COVID, right? In early 2020, where you had this little like zigzag move and then a huge rollover, right? So this rate of change blowout tells me there's legs in terms of more dollar downside. And the trades that you're talking about are only going to benefit more and more from that. You want to speak to that?
Yeah, so if we're looking at gold, it's going to love a weaker dollar here. It's been doing well even in a strong dollar environment. A weaker dollar, it's been going crazy. So that's
Yeah.
going to really help. International stocks, part of the reason why you've seen this massive this is the thing nobody talks about, Steve, which is part of the reason we've seen this massive underperformance in international equities is because the dollar has been strong since 2008. It bottomed around that time. It's been an uptrend basically ever since. These things can't catch a bid if all the money's going into the United States and the US dollar and so on. So they're not catching bids really during that period of time. So for them to catch a real bid, you need a weak dollar scenario. And this could be the beginning of a large weak dollar move. And I think international stocks are saying that. I think gold is saying that. And I think that's part of the story we're seeing today. Basically, get out of the United States, look at some of these other areas. If you are in the United States, there are some great sectors, but they're just different than they used to be. Look at gold miners, look at water. Like all of those sectors are actually doing pretty well. So I like that thought on it.
Talk to me about this ASC Gold Rush Index. Speaking of the gold miners, what'd you guys do? Look at this. Like, this is one of those base breakouts. We're talking about like these base breakouts in Germany and stuff through the financial crisis highs. That's the same situation with this chart pattern here, is it not?
Yes, and you can people continue to go, oh, the gold miners are not that great. Oh, gold miners, gold outperforms. You're right. Gold miners are bad companies. A lot of people who are gold bugs never like to say that, but that's the truth. They're bad companies. They're not run well. Sometimes they're just fake holes in the ground.
It's just a bad model.
It's a bad model.
Beyond the fact that they're not run well. I mean, it's one of these capital intensive businesses
There's
where
very few I've seen run well even, so it's a capital intensive business that isn't run well usually.
They're literally trying to strike gold, and that phrase has a couple of different meanings. Yeah.
Yes. And so but at the same time, where are the biggest gains made in a precious metals bull cycle? It's always in the miners every single time. So yeah, I get it. You hate it. It's not the funnest area to be, but finding some of these large names inside of this index, which will kind of take off. Now, once again, NEM, not a company I really recommend, but a lot of the other names look pretty good. Wheaton Precious Metals looks good. AEM is another company I own.
Right.
So some of these things look good. I like these things. But at the same time, when you get into that junior complex, now you're talking about the real moves happening. So I like the idea of owning some of the big names. I like the smaller names even more. Those things could really take off, and that's where the alpha is going to be.
And this is a custom index of the largest, most material names. Is that right?
Yes.
And like
equally weighted.
Every cycle you have gems coming out of the mining space. You remember Kirkland Lake from a few years back?
Ooh, KL, yeah. I own that one too. Yeah, it's gone now.
Strongest stock in the market through a bear market for precious metals. They struck gold, right? And then they get acquired for many, many multiples higher of the stock price if you can catch it. So you always find these big winners. I love the idea of just leaning into relative strength. Jason, you brought a couple of charts here that they're at the end of the deck. Do you want to speak to them?
Yeah, real fast. We'll go through the oil one and then the CRB USB.
Talk to me.
So Steve and I were talking about oil. We were like, hey, oil's looking for a bounce here. And so Steve wrote about it. I actually put out a piece about it. Kind of two different ways of looking at it, but we're looking at the same thing. Positioning here matters. So when you're looking at the COT reports, most of the time you see these bounces happen in things like oil when you're seeing the red line showing that commercials are buying. Those are the people in the know. Those are the producers that produce these products. And then the green line is selling, meaning the speculators, the funds, also the retails. They're selling pretty heavily. So you usually see in that scenario when the smart money is buying, you want to also look for a bottom. So this is where a bottom can happen. Not to mention we're sitting on a perfect support zone. And look at the bottom line, which is black, which is open interest. Open interest is falling as we're seeing commercials buying. That's usually very significant. A lot of people overlook that fact when they're looking at COT reports. And the top index, that's just basically a rate of change on the COT commercial buying. And when that hits the green line, we see buying. So I think it's a good time to kind of look for a bounce here. Am I looking for oil to reverse trend to go higher? No, I'm not. But I'm looking for a bounce back up to around 75 to $80, I think is a good bounce and logical. I don't think it's something where I think, hey, this is going to go up forever. I'm just looking for a small bounce, small reversal.
And honestly, in these messy markets, just take the quick hits, right? We're not betting on some major trend reversal. Oil has been sideways for as long as I can remember at this point. It's been several years, right? We're just betting on a bounce. And in these markets, you you could take those wins all day. Quick hits.
Yes, quick hits. Sometimes you got to do that. Reversal models are a great way to do that. Let's hop into the last one real fast.
Talk to me.
So when we're looking at the CRB USB index, this is something that I always find is significant.
This is great.
Yeah, it's always significant. One is, you could look at it big picture. Go to the .com bust. Oil is basically under $10. It was news on the cover of everything. I even saw it as a kid. And then get to the great financial crisis. Oil goes from under $10 in .com bust, great financial crisis. Oil is up to all around $150. So then it continues into a massive downtrend for years, basically underperforming stocks crazily and bonds, everything basically. Oil just was terrible for many years. COVID crashes. You get this negative rate oil in the front month contract, negative $50. Then the COVID crash happens. That was the biggest capitulation point you could ever get for anything, almost ever. And then it goes the other direction. And I think oil's in the middle of kind of a super cycle. Do I think that like you're just going to own things through a super cycle without any pullbacks? No. But I think that this consolidation here is going to lead to more upside in oil at some point. And this chart is the CRB index against 30-year bonds. And that started to underperform a little bit at the end. That's why I left the thumbnail at the end kind of showing you guys it did kind of come down for a minute, but now that's bottoming and going the other direction against bonds. Usually when you see that happen, we'll see some more upside in oil. So there's a bunch of reasons to be a little bit more excited about oil lately, at least for a bounce. But I still like for trends, gold, copper, silver. That's where you got to be right now.
And maybe that's the bigger point, and maybe it's oil in the future, right? Because Jason, you taught me this. Gold always leads. And what this chart here really shows is commodities on a relative basis, but also on an absolute basis, right? When you have a low volatility denominator like this in a relative trend, it's the numerator that's moving it. Commodities absolutely launched off of their COVID lows, and it was like May of 2020, right? They went in a vertical line higher for 2 years, and then what happened after that? They went straight sideways, dead for the last 3 years. You just said it. This is one of the most historic rallies ever that commodities have ever seen.
Yep.
That's take some time to digest. No, 3 years of sideways. I'm okay with that after the 2 years we had from 2020 to 2022.
And then last year we had oil breakout in January, gold broke out in January 2024. And now we're getting back to a point of going, maybe gold or maybe oil is bottoming. Copper looks like it's raging. Seems like a good time to start looking at some of these things like oil. But once again, we're long copper, silver, and gold. Yeah. Oil is probably going to be the next thing. So like you said, keep it on your watch list. Let's be ready for it.
Gold kicked it off again, Jason. I really think that's it. And you do such great work on gold. We have the Gold Rush product. It's absolutely fantastic. I mean, Jason's writing about this every single week. You're looking at these charts every single day. You're trading them. You're in these markets. So there's really nobody better to follow when it comes to this. If you want to talk a little bit about what you do on Gold Rush, I'm going to check the chat because everybody's talking to us right now. Guys, if you have any questions about these uncorrelated trades, now's the time to ask them. We'll do like a quick Q&A. For the next 5 minutes, if you guys got anything.
Yeah, no, perfect. But yeah, Gold Rush is great. Sam and I find all types of great trades, whether we're looking at grains, whether we're looking at softs, we're talking about cocoa, coffee. We've been on those trades for years. So all of those trades are things that we find and always are looking at. Also, if you guys who like stocks, you guys want to find miners, you want to find other stocks in the energy sector and so on, we look for those as well. So anything you guys want to take a look at, natural gas being another one that's been a huge winner lately as well.
So to be honest, the name Gold Rush, I like it a lot, but it's misleading, right? This is not about just gold. This is Jason's commodities letter. Is that fair?
Yes, it's just a commodities letter, and we talk about it all. And being honest, Steve knows I have a way of because of trading this stuff. I can't help myself. So it's sometimes we get all the way into bonds, currencies, because it all is connected. Like I'm talking about here today, international stocks are connected to copper. International stocks are connected to this gold move. International stocks are connected to the dollar. So you got to know all of those things. And I think Sam and I do a great job of kind of going over those. We do a video once a week as well for our subscribers. Just to kind of go over those things once a week and show you guys the big macro landscape and then what we're trading inside of it.
Fitch just said, I can't believe I'm buying Italy and Greece. Man, I feel the same way. I get it. But here's the beauty. Here's the beauty of it all, right? Say US equities, which have been so good to all of us. I get it, right? I don't want to lose that either. It makes me very sad selling my US equities. But we have other options. It's not the only market. And Jason's made a good point of just talking about how liquid some of these markets are and how available they are, right? So we're going to keep talking about them because they keep working, whether it's commodities, international stocks, whatever. Guys, there are other options. We've been spoiled with the US growth trend. Okay, over the past decade, we've been very spoiled. It's not going to last forever. Let's be prepared for a world where that's not the best game in town anymore.
No, I agree. I think it's just an ability. Macro traders basically have an ability to trade anything liquid and not think too much about what it means. Because at the end of the day, it's like I'm trying to make you guys money. That's it. My goal is to figure out ways for like Steve. Steve will go golfing when things get a little bit rough in the markets. I'm also managing money for clients, so sometimes I have to find different trades. So you guys who are always trading, like we're always coming up with new ideas. Steve is always coming up with new ideas, even though he says he's golfing. He's got plenty of ideas that are coming out there still all the time. So I mean, we're always trying to find ways to make you guys money and figure out what you guys should do. Not to mention hedge against losing money, because that's the big goal here. Try not to lose money, and most of the time that'll open up the upside for most of you guys.
Jason, would commodities be as inversely correlated as international stocks are to the US? Historically, you mentioned the dollar strength since '08.
Yes. So the great thing about commodities is one, there's so many of them. There's been very few times. I can only think of late 2020 through 2021 was the only time I was ever long all commodities basically. I remember I even wrote this down. Like it was a big thing that I wrote on a poster board, like one time in history of trading my systems and strategies. So they were always extremely uncorrelated. Sometimes, like you're seeing now, the energy sector isn't all going up, but natural gas is ripping. And then you have certain things like oil not going anywhere. So most of the time, that's how the commodities trades work, which is great. It always sets you up for either something to short, something to be long, and it's all very uncorrelated to the United States market. And it depends on the environment. A deflationary shock, if you're looking at 2020, for example, everything will go down. And the reason why is traders and funds, they need money. So as they need money, they're going to go to cash as much as they can. They're getting margin calls or whatever, and everybody will be out of everything at the same time. It's a rare event, but it does happen. That's a liquidity event. But most of the time, you're just going to see all these things moving in many different directions. Even when no commodities were moving a couple of years ago, cocoa was raging, coffee was in a bull market, sugar was also moving as well. So it's an interesting market for sure.
Guys, the link to Jason's stuff you can find in the YouTube chat if you're watching on YouTube, or you can simply scroll down if you're watching on our website on Stock Market TV, and you'll find the page down there. Now that the 8-minute abs advertisement has ended, do you remember Richard Simmons, Jason?
Yes.
I'm not kidding.
Of course.
It was the early days of the internet. When I was a freshman in college, we used to, we all worked out back then. We were young guys. We would play the 8-minute abs video on YouTube with Richard Simmons or whatever, and we'd be like in these tiny dorm rooms that were like literally little boxes, like 5 guys just lined up, like doing crunches and stuff. I think back now, so, yeah, I'll always remember him for that.
We won't talk about that again. All right, everybody who's watching, don't tell anybody about that.
So, guys, we're also, we've been big on the uncorrelated trades in our breakout multiplier system too. We just keep going to other areas and staying away from U.S. stocks, and it continues to serve us well. Jason, have you noticed what happened since we started talking? It doesn't look like it's over for U.S. equity. So I think that remains the playbook right now, and that's so important, right? So we're going to keep buying defensive stocks, international stocks, commodity-linked stocks, or frankly, we have equity vehicles that are just not equities at all. Right? Where we can buy things that are, I don't know, commodities in the stock market, right? So we just got long some USO calls the other day. We're going to take different shots on these uncorrelated markets because I think this is really we're on collapse alert for US equities, and you're seeing it right now. The selling's not done yet. We can't even put together 2 straight up days in the US stock market. It's just not time to dip your toes in yet. So there are other ways, and that's what this video today was all about. Chat, thank you so much for coming here and keeping it interactive. I need 8 months abs, methinks. 8 minutes ain't gonna cut it. Dawson, you and me both, brother. I need 8-year abs at this point. I can't I can't believe it either. Rachel, we had YouTube and LimeWire, right? It was a little after the Napster days back then.
LimeWire, I remember that.
LimeWire,
Yeah,
right?
I had that too. It's great.
And just another casual 600 plus down day. That's it, guys. Read the tape, right? That's where we're at right now. Tomorrow,
And
could be
Brazil
a
and China and Mexico are all up today. Wild.
There are other ways. We're going to continue to lean on these pockets of relative strength and these just other asset markets to get by in times like these, because that's just what we do. Jason is like the master trend follower, our head of macro. Thanks so much for joining me today, dude.
Hey man, this was fun. I'm glad I mentioned that we should get together and do this. I'm glad we got a chance to do it. This was a lot of fun. Sorry about the new office, guys. I'm figuring out the lighting. As the day's moving, it's just kind of moving around. So, but thank you guys so much for hanging out with us. This was a lot of fun, and we'll see you guys soon.
We planned for this to be 25 minutes, but we just can't help ourselves. So thank you all for hanging out. We just love this stuff. And it's also come to my attention that the 8-minute abs advertisement was actually a targeted ad. So you probably didn't all see that. It's my own problem. This has been fun. We're going to do more of these in the future. Thank you all for joining us. Again, links in the chat or just scroll on down if you're on the website. All right, everybody, have a great weekend.
Be on the lookout for the abs, 8-minute abs all-star charts live next week.
No, that's a scam. Bye, everybody.
Later, guys.